Good afternoon, everyone. Thank you for joining Morgan Stanley Virtual India Financials and Fintech Seminar. My name is Subramanian Iyer. I'm a member of the Morgan Stanley Research Department and I'm moderating this session. Today we have with us Mr. Sanjay Mundra, President from Shriram Transport Finance. We are extremely pleased to welcome him to the Morgan Stanley conference and look forward to his insights and commentary on the company and the industry. Before I hand it over to Mr. Mundra, a standard disclaimer. Please note that there are participants in this session that are not members of the Morgan Stanley Research Department. These persons' views are their own and may differ from those of the department. Please note that this event is for Morgan Stanley institutional clients and financial advisors only. This event is not for members of the press. Without further ado, let me hand it over to Mr. Mundra for his opening remarks, after which we can go to Q&A. Over to you, sir.
Good afternoon, friends, and the people who have joined. Hello to everyone, and hope you guys are all safe. As you know, just 1.5 months back, we came out with our quarterly numbers, and at that time, the second wave of COVID was looming around the country, and since then, if you look at, the situation has improved considerably. The vaccination process of the government has taken a big shape. So most of the working class has either taken the first dose or the second dose, Coming on the economic activity as such, as you know, unlike the first wave of COVID, where the central government announced the lockdown, but in second wave of COVID, the entire responsibility were passed on to the states, where various states, till now has done a lot of unlocking, bearing some schools, cinema, also some restrictions, in terms of occupancy and etc. But since then, the economy and the activity has increased tremendously, and as far as the movements of the vehicle, unlike in the first wave of COVID, where first 30 to 45 days, there was absolutely a lot of restrictions regarding the interstate and the intrastate, depending on the containment zones and etc. But this time, there was we haven't heard any problem, in terms of plying the vehicle, and as during that time, last quarter, we did register the collection efficiency of around 91% on an average for the quarter. And probably as of now, we feel that we have gone back to the normal level of collections as far as we are concerned. As far as the economic activity, freight rates, utilization rates, that's improving with the every passing of the day, As you recollect, we have always said that, when the second wave of COVID came, the availability of the freight was sufficient there. Only thing is that because various states had various restrictions, so the supply chain distribution was the biggest impact, which I think has improved tremendously. I think supply chain, which came down to around 70% or so, has moved up around 85 to 90% right now. So the utilization rates for our customer, which came down to around 21 days, has moved to around 22-23 days. As you know, in the country, the fuel price has been rising consistently, but the freight rates are very much there, and it's very, very much viable to run the asset right now. So if I look at the fuel cost adjusted, freight rates are still up by between 5 to 10%, So whatever the increase in the fuel cost has been there, that has been passed on to the customer. As far as the disbursements is concerned, if you recollect, we did around 120 billion rupees worth of disbursement in the last quarter. This quarter, it will be higher in spite of the monsoon quarter, which are slightly weaker than all the time what we expect, But the disbursements are very, very strong right now, and hope so keep the third wave of COVID, which people were expecting in the month of August and September. So that impact of the third wave of COVID is still not felt, and hope so this is behind us. And going forward, the economy will take a good shape as far as the uptick growths are concerned. Then coming on the little bit on the loan book growth, as you recollect, in spite of COVID, second wave of COVID, we said in the conference call, the first quarter conference call, that we will definitely will be having a double-digit growth, and we are stick to that. And if the demand and the growth remains very, very strong in the second half, then it could be slightly higher also. But as at this juncture, we feel that double-digit growth is what we feel. As far as the credit cost is concerned, if you recollect, prior to the second wave of COVID, which was in the March quarter, we thought probably this year we'll end up around 2.1% kind of credit cost. But because of the sudden spike because of the COVID-2, and this time, as you all know, the impact was on the rural side also, So we feel that by the end of third or fourth quarter, we'll get back to the 2%. But in spite of that, we feel that the credit cost will be lower than the last year. Last year, if you recollect, we registered around 2.48% kind of credit cost. So it should be lower. Hopefully by third or fourth quarter, if there is no further third wave of COVID, we'll come back to around 2% kind of credit cost. As far as the restructuring is concerned, as you recollect, we did around 3 billion rupees, which is 300 crores of restructuring, in the second wave of COVID. And we feel that another 300 to maximum 300 to 350 crores is possible. So overall restructuring, if you look at from COVID-1 to COVID-2 inclusive, it should be around 1.1, maximum 1.1 to 1.2% of the total book. Though the option was very much there to do the restructuring, as you recollect in the first quarter number, there was an option to do either restructuring or take a hit through the P&L in the stage 2 and stage 3. We prefer taking a hit through the stage 2 and stage 3. And as you know, that is why the stage 3 asset got increased by almost 100 basis point, and stage 2 went up by roughly around 300 to 400 basis point, which we feel, if the way the economy is going, probably by the end of third quarter, there will be a huge reversal of those things are happening. So coming on basically now the utilization rate, freight rates, what we have discussed, it seems to be that the used vehicle prices are doing very well. We have already indicated in the conference call that in some model, definitely used vehicle prices has gone up by roughly around 15% or so. But on an average, in each category of the asset, it has gone up by roughly around 5 to 10%. And there is a strong case that probably, in next 1 month or so, the OEMs are going to further increase the new vehicle prices because of the commodity prices and etc. If that happens, then the used vehicle prices can further move up by roughly around 4 to 6%. That's what we feel, which will be the very, very strong case, for basically the lower credit cost. That's what we feel as of now. As you recollect, in the first quarter, we made around 2.6 billion rupees of additional provision, but that was restricted to around less than 3% of the asset, which is mainly in the passenger segment, particularly the aggregator model, school buses, and some staff transfer. And where we felt that, these were the vehicles which were not running, So there could be some destruction in the used vehicle. But out of this, many of these assets started working and people started paying the money in the part or in full, So as of now, the things looks like, probably on the third quarter, we are looking for the full-fledged growth. Though the second quarter, because this is a monsoon quarter, generally monsoon quarter, because the turnaround time taken by the vehicle is slightly more. And this is a every year phenomena. But in spite of that, we feel that probably we will register a very, very strong kind of numbers, as far as we are, because the disbursement, the collections, everything's are pretty good, which is coming to our long-term average, So Subodh, this is my generally the initial remarks. Now I leave the floor for the Q&A session.
So, sir, thanks for the overview. Just wanted a clarification. So on the collection efficiency, you are saying that now basically it has come back to say kind of normal, say in the month of August or so?
Yes, absolutely. Normal average rate, what we do collections.
So your normal, one should assume, is in the early 90s, right? That's the way to think about it.
whether it's early 90s or slightly lower than 100, that, is very, very difficult to give you the exact number. But long-term average, we have achieved in both the months.
Okay, got it. Okay, so on the disbursement side, also you are mentioning that basically, so you mentioned that on the second quarter, the disbursements can be quite strong compared to the, say, normal monsoon, say, compared to usual when, say, this quarter typically sees a bit of a slowdown. So you are implying quarter-on-quarter or year-on-year, quarter-on-quarter basis?
I think, to be whatever we have registered probably in the fourth quarter, if you recollect last year, probably it could be on the similar trend.
Oh, sure. The other question is from investors that has come in is that, say, with respect to the new scrappage policy, what is the impact that you are envisaging from FY23 onwards? And do you think that you will have to do more new vehicles to maintain the AUM? So that is the other question.
Not really, to be very, very honest. Still we are not very, very sure what could be the incentive which can be provided by the government, in terms of reduction in the registration cost, or, they have talked about 5% of the value of the current value of the assets. So these are some of the things has not been clarified. But having said all these things, what we feel that, as you recollect, we feel that there are roughly around 1.35 to 1.5 million vehicles which are beyond 15 years of age, and even if 10 to 15% of these additional vehicles come for the replacement, that will give us sufficient growth, as far as, because, when you talked about the, basically the replacement of the vehicle, that means the guy who owns 16, 17 years won't be able to buy, 5, 6 years or can convert into the new vehicle. But definitely, 10 to 12 years, they will try to migrate. And then the 10 to 12-year guy will buy 6 to 7 years. And that is how the things are going to move, But our customer upgrading because of the scrappage policy seems to be very, very few of them will be doing so.
Okay, noted, sir. Now, the next question is on margins. So, how are you thinking about margins, and if you were to split it between loan yields and cost of funds, so how should we expect going, say, in the next 12 to 24 months?
See, as you know, we have always tried to deliver 7.5% net interest margin, but in last 3-4 quarters, the margin has come below 7%, and the major reason was the extra liquidity what we are carrying on the balance sheet. Today, if you look at the extra liquidity what we carrying in the balance sheet is almost more than 2.5 times what we used to generally carry, and since the short-term rates in the country has also came down dramatically, so that is why there is a huge negative carry what we are carrying because of the extra liquidity in the system, which we hope, will get rectified over the time as the economy progresses, number one. The second thing, as you recollect, when the NBFC crisis broke out in 2018, which is probably August or September 2018, since then we were almost borrowing at roughly around 9.5% since then, and last 1 year, post-August 2020, the cost of funds were dramatically came down for us, Even prior to that, we were borrowing at roughly 9.5%. Now, almost we are borrowing in all the liability profile, below 8%, sub 8%, in some cases it's 7.5 also. But more than 90% of the liability what we borrow are the fixed price liability. So as these liability over the time get replaced, the cost of fund will start coming down for us, So we feel that going forward, probably we feel that by end of, third quarter or fourth quarter, definitely we will be very, very close to 7, if not above 7.
Okay. And on from a loan yield perspective, are you having to pass on some of this benefit as well to your borrowers, or loan yields one can assume to be fairly stable?
No, it should be same. Generally we don't do such a dramatical change, as far as the lendings are concerned, because right now focus has been on the used vehicle. So I think going forward, even the yield can be slightly better, going forward.
Okay. There is a question on, say, from an asset quality perspective. So how do you see your provisioning with LGD still at 45%, and will this 45% number move lower, given that historically this has been a lower number?
See, LGD is the one thing, we increased from around 42, 43 to 44, 45 in last quarter, because on the, some specific asset, as we have already mentioned, and I mentioned in my opening remarks also, for some of the passenger vehicle, like, which is less than 3% of the book, where we increased basically the LGD by roughly around 10% in those cases. That is why the LGDs are slightly higher. Now, if historically, if you look at our LGD was around 32 to around 32%, could be 100 basis point here and there. But when we made around 26 billion rupees worth of COVID provision in COVID-1 for the COVID-1, that is how we have adjusted systematically by increasing the probability of default in the stage 1, stage 2, and stage 3, and we have increased the LGD by almost 10 to 11%, to adjust that. So that 44%, in between 42 to 43% will remain. And a lot of investor keeps on asking the question, when we are going to reverse the provision if nothing comes. And we have very much clarified that the asset what we had in March 2020, these assets are going to mature in 2023. Till then, we are going to carry those extra provisions or the COVID provisions.
Okay. Okay. So basically, your credit cost guidance of say getting closer to 2% in the next year, that doesn't assume basically any reversal of provisions. I mean, that is
yes, absolutely, absolutely.
So for the so there could be like a period of time, maybe the next 12 to 24 months, where you might continue to see the coverage ratio staying elevated.
Yes.
Okay. There's a question on operating costs. So how to think about, say, operating costs going forward? Would it grow? Should one assume it growing faster than overall asset growth, given that you might want to hire as the growth picks up a bit?
But you see, these are the continuation thing. If you look at even 2018-19, we hired a lot of people, but our cost to income ratio always stood at near about 23%. Could be 100 basis points here and there. So we feel that going forward, it should range between 22.5 to 23.5. This should be the range.
Oh. And okay. There is a question on basically, so there was a decline, say, recently in the working capital loans that you were giving, and so how is that trending now? I mean, should one think of that as a measure of economic activity in the trucking industry? I mean, the movement in that as a percentage of your total assets?
See, the working capital loan, because the tenures are so short, that you can't increase that tremendously. And we have always said that the working capital loan and the business loan put together should not be more than 7% of our total book. So this is a strategy. So once you mainly is the fuel credit, which are around 20 days. Only the insurance component, where people repay the money in 12 months. Otherwise, if you look at the tire credit and other kind of loan, the tenures are roughly around 3 to 6 months time. So I don't see that because of that, it's reflect the economic activity. Is that it's a conscious decision, because there was a 6 month of moratorium where the customer didn't pay. So they didn't ask for any kind of working capital help also. But even though it's come, it won't be a very, very significant as far as our loan books are concerned.
Got it. And there was in your last conference call, there was some mention about some new initiatives. So on the from an asset class perspective, say in addition to the existing asset classes that you lend to, which are probably the new segments where you are likely to make a bigger foray, and say what are the other initiatives like say adding more partners in order to say get loan growth? If you can talk about that a bit.
See, let me tell you, the initiative what we are doing, trying to do is to help the customer, digitally, where all of his needs, can be addressed through that digital platform. It's not that we wanted to do any new class of asset in that. I think whatever the asset class, because ultimately we have to lend against the earning asset, So if you look at from the passenger side, from the three-wheeler to MUV, SUV, travel agent, aggregator model, school buses, route buses, and everything we do. We do tractor, we do construction equipment, we do commercial vehicle, both from everything from 1 ton to up to 49 tons, So I don't think so there is going to be increase in other asset class and etc. But what happens is that if more and more people can come to that, then the later part we can look at some kind of fee-based income as of now. The other thing about the digital initiative, I just like today we have all the modes, whether it comes to the disbursement, whether it comes to the repayments, whether it comes to the, the KYC, whether it comes to the, getting the customer on the board and etc. But these are not on one platform. Everything has got a separate platform. So all these things we are trying to bring under one platform where, where a lot of other partners can participate. That does not mean we get into the other asset class, but within that working capital and other kind of things, that portion can increase slightly more, but that we have restricted, as I mentioned in my earlier question.
Okay. There is a question on if you can speak a bit about your ESG initiatives and then how does your overall business screen from an ESG point of view?
See, ESG has always been a very, very important part, So if you look at from the ESG perspective, particularly to the environment related, I think, we are trying to get, the customer vehicle much, much younger. If you recollect, till 2006-7, we were doing between 5 to 15 years of age. In 2010, we reduced it to 12 years, And then I think 3 years or 4 years back, from 12 years, we reduced to around 10 years, So that is how we are trying to, do that so that the customer vehicle should be very, very younger. The second thing today, if you look at all these batteries and all these things are there, so we are trying to finance those vehicles, so that it should have been the clean energy on that front. The third part, some of the smaller vehicles, are trying to get converted from the diesel vehicle to the electric, or could be to the CNG and etc. There also we started funding, so that the customer can upgrade their vehicle, from the diesel to the clean energy also. So if they want to convert that, if for change of you require some engine work and etc. For there also we started financing. So this is particularly related to the environment, As far as social is concerned, if you look at our business model itself is a very, very socially initiative, because when we acquire a customer, the formal credit to those customers not been offered by any of the banks or the financial institution. So we acquire a customer, and the only option with the customer is to get the money from the money lenders who charges higher interest rate, probably 5 to 10% higher, depending on the geography and the customer profile. So today when we acquire a customer, we are offering a lower interest rates, and over the time in next 5-10 years, when these customers become big, have 5, 10, 15 vehicles, now they have to file income tax return, they have the balance sheet. We allow them to get into the banking channel to have to get the loan at a lower cost, So if you look at the business as such, our business model itself is, fully in terms of social, where these small truck owners or the driver owner who doesn't have the formal credit, to uplift that.
Sure. There is a question on basically the update on the merger process. So in the last quarter, you had given an indication that there would be some steps taken towards the same. So if there's anything that you can comment on there.
See, let me tell you, because of, this is 3 years back, we said that, but we probably came to one solution. At that time, the merger process was between the two lending arms and the insurance companies. But in December 2019, we have very much clarified, because RBI was never very comfortable in holding more than 50% in the insurance company by the NBFCs. So after deliberation, we came out that insurance will not be a part of the merger process that we have communicated. But suddenly the COVID-1 and thereafter, the COVID-2 started. So the immediate job for the senior management or in the group was to get back to the company at the normal level of business, both in terms of collections and the lending. So that was taken a back burner, and suddenly we started feeling, that we are basically, the entire operations are under the control. So we started the process of the merger process, and that we have highlighted in the conference call also. Okay, the merger will be between Shriram City Union and Shriram Transport as of now, and the insurance business will be kept separate out of that. And we feel that by the end of this calendar year, we are trying to announce the entire merger process, though the process might take a little bit more time. But as far as the announcement and everything are concerned, probably we'll announce, in this calendar year. That much I can tell you on the merger as of now.
Okay, sure. And there is a question on your capitalization and leverage. So the question is that, say right now you're already over 20% tier 1. Structurally, where do you expect is a normalized tier 1 that you can operate at, say once you start levering up again?
See, we have very clarified. Once the COVID situation, goes out and that fear is not there, definitely we can reduce the tier 1 capital also. But till the threat of the COVID is there, as we have always mentioned in last 3 to 4 conference call, quarterly, that we love to be at around 20% in terms of tier 1 capital.
Okay. Yeah, but structurally, is there any number beyond COVID? What do you think?
Beyond COVID, if you look at, yes, if you look at in the past, we have gone to up to around 16-17% tier 1 also.
Oh. There's a question. There's a follow-up question on the merger. On what kind of synergies are you seeing from the merger that are likely to accrue?
See, we have discussed numerous things about, and about the cost benefit, both in terms of operation cost and the cost of funds. And we feel that Shriram Transport, the ratings are AA+, and Shriram City Union, the ratings are AA. So immediately for Shriram, basically the SCUF, we feel that benefit is immediately going to come. And going forward, there will be a strong case, that the rating get to the AAA rated, which is the highest, that's one part. The second part is that if you look at over the time, the rating rationale always provide us the monoline and one cyclical industry, So probably if you get 25-30% of the consumer finance asset, so that part might go away, and there will be a strong case as far as the rating upgrade is concerned, and the volatility in terms of growth and everything can be well maintained, The third part is that the cross-selling and etc. Though definitely for Shriram City Union customer, you can't sell trucks. But for our customer, if he required two-wheeler for his son or some of his gold loan and etc., that can be easily provided for. Number 4, as you know, the disruption because of the merger in the operation will be 0 days, because both the companies are run on the same IT platform. So what we trying to do is that how to increase the revenue per customer, that's what we are thinking in terms of whether it's a cross-selling or fulfilling his entire needs, etc. The fifth point, if you look at the entire financial services segment is concerned, we feel that the younger generation, the digital initiatives, which is the theme, probably going forward, if you don't offer more product to the customer, not immediately, but going forward, probably after 3 years, 4 years, as the generation change, the retention of the customer, what we feel, can be done in a much, much better way, And overall, on the broader side of it, if you look at how the financial services industry has been there worldwide in last 2-3 years, the people who have a scale are the biggest beneficiary, both in terms of availability of the liquidity or in terms of equity, and the bigger investor can participate on that, So these are some of the points, rational, what we feel, will help us. Now, to summarize the entire point, if you look at the merger, have always been the part of Shriram Group. Some of you might have aware that in till 2006, even the transport finance business, we had 4 regional-based company, and we merged all the other 3 companies into the Shriram Transport. At that time, the loan book of that of the company was roughly around 35 to 40 billion. And look at from 40 billion how we have grown, almost 30x in last 13 to 14 years in terms of loan book, So similarly, then if you look at the initiative, till 2007, we were almost a truck financing company. We converted from truck financing to the commercial earning asset financing company by adding tractor, construction equipment, passenger commercial vehicle, and others, to how. So then it was, since we were growing fast, the auto mall concept we started where we can facilitate buying and selling of used commercial vehicles so that the customer doesn't wait time in upgrading the asset, So these are some of the things has continued over the time. Some was definitely we have initiative a new product, and some we did, with the merger and etc. So this business model we have run for last 40 years, and probably we see how the financial services segment is going to evolve and how we can move forward, So this is just a process in that direction.
Got it. There is just a last follow-up question on this. Would it be correct to say that there is only 10% overlap on the asset side by types of asset the investor who's asking?
No. See what happens. They do slightly more, basically more than 10 years also. Suppose if I have to give some personal loan against that, if I have some asset which is 12, 13 years old, so they do that. But I don't think so there is any overlapping in that.
Got it. There is a question on margins that from perspective of margins, where is your new disbursement coming from? Is it largely from rural areas, and to that extent, could we consider it as higher yielding?
Yes, it's a semi and rural area. That's a maximum. If you look at the urban growth has not been there, we have been able to maintain that. But I think the rural and the semi-rural having a better growth, and we feel that even the yield, might increase, little bit as you do more in the rural and the semi-rural area.
Got it. There is a question on the industry structure. So the question is that given large part of the industry is still organized, what do you think are the reasons other lenders have not been successful? And do you think going forward there could be strong competitors emerging using your learnings? Some lenders seem to have very ambitious plans.
Yes, definitely. And this has always been the case, in last, if you look at, 10 to 15 years, we have seen, some serious, 5-6 players try to get into the used commercial vehicle market, but let me tell you, none of them was successful, and whenever the things goes better or in the new vehicle, there is a huge competition from the banks, some of the other NBFC try to do that, but I think these are more towards, getting the better rates, because new vehicle, the rates are very, very competitive and they want to do some used vehicle in that process, but we exactly don't know whether it's a used vehicle lending or the refinancing what we do, but for them, this is the secondary part. For us, this is the primary and secondary part, So as of now, I can tell you nobody has threatened Pan-India. Yes, some geography, some people are doing some here and there, but Pan-India basis, we haven't heard anybody has really threatened us. And in terms of size also, if you look at, nobody is not even 5% of our size, what we do, So yes, some people can come and do 5-10% here and there, but you need to understand that even the unorganized sector, still we feel is more than 50% of the market, could be 50-55, very, very difficult to analyze. And the 5 to 10 year category, we are 27 to 29%, and 15%, 16% could be all banks and NBFC put together. But I think even one or two players come and take 5-10% market, I don't think so we are going to get impacted because of that.
So there is a question on the securitization market on how is that panning out. There was a bit of a slowdown in between in terms of the amount of securitization that the banks were buying. So how is it now shaping up?
No, securitization we continue to do, and it's not that the demand on the securitization is not there. It's there because if you look at lending on the balance sheet of Shriram Transport also classify as a securitization. So whether the guy is lending on the balance sheet or whether it's buying on asset, buying the asset, it's the same thing. And the priority sector demands are very much there. So some bank prefer, you lend on the balance sheet, that also classify as a priority sector for the banks also, So that changes has been made by the Reserve Bank of India, I think 2-3 years back, again. So you have to look both the securitization and, the bank borrowing, who wants to have the priority sector asset.
So, the other question that we have is, this probably has already been answered. Yeah, I think this you have already answered, but I mean, the question is that whether basically from a AUM segment, AUM growth perspective, I mean, do you see scope for you to diversify into any more segments which can bring in more growth, or in the absence of which, what is the kind of sustainable loan growth that you think that you can keep delivering through the cycle?
So I think, we are there to deliver around 14 to 16% kind of loan book growth for next 3 to 5 years, In between that, depending on the economy, some years could be 10, 11, 12%, and some years could be 17, 18%. So this could be there. Coming on the other asset class, I don't think so. There is another big asset class, which is due. Yes, definitely on the electric side, there could be, but that's part of those assets, whether it's a LCV, whether it's an electric car, tourist car, and etc. But other side, as of now, we are not thinking any other new asset class.
Got it. And the other question is that beyond what size do you think that you might say explore becoming a bank, or do you think that at these levels of growth you can sustain as an NBFC?
I think we can sustain, if you look at, there are three NBFC who have the larger size than us, and one is HDFC. If you look at, the LIC Housing Finance, so I don't think so at this juncture we are even thinking because of the scale we want to convert into the bank, I think the financial markets are itself growing, and that is how if you look at our liability profile, because most of the people are see, from how the company will be able to raise the liability. That is if you look at, there are five broad liability profile what we have, Retail, if you look at from 11-12%, we have already been around 17-18%, more than 17-18%. Securitization is there, is still around 20%. Then you have the international borrowing, you have a bank borrowing and the capital market. And we have, particularly last, 2 quarters or so, we have said that we want to remain in between 20 to 25% in all the liability profile, So even if you look at, say, you assume you go up to, say, 2 trillion rupees worth of asset, that 20% is just 40,000 rupees for each category of liability side, which I don't think so there will be a big issue as of now.
Got it. There's a question on the lending side that do we plan to keep LTV at the same level as the last year, or is there any scope to increase the LTVs incrementally?
If you recollect, and we have been telling across all the conference call or in the meeting that LTV which we reduced by 4 to 6%, when the NBFC crisis broke out, and still we are continuing with that. And once the COVID situation remains out of the world, and then we have to look at how the Indian economy is progress. Based on that we will take a call. Right now we are working with the reduced LTV only. And when I discussed about the double-digit growth, we have not factored increase in the LTV.
Got it. Sure. And I mean, while this is a tough question, but if at all, say there is a third wave of a similar magnitude as the second wave, then how do you think you are prepared for it, and what kind of implications would you imagine as of now on the business?
See, business, the important thing when any of these unforeseen events come, the important thing is on the collection side. And if you look at, there's a big initiative, post demonetization, what we did through the digital mode of, collections, And today I can say that roughly around 40-45% of the monies are coming through the digital mode, as far as the collections is concerned. And I think with every passing of the year, 5 to 10% of the money will start coming by way of digital collection from the cash to that. So if you recollect, probably 5-6 years back, more than 75-80% of the money, more than 2/3 of the money used to come through the cash, Now that cash component has come down to around 40-45% for us. That's one part. The second part is in terms of process, in terms of, like in auto malls, or when you decided to purchase a vehicle, the online platforms are also getting into the picture, where you can buy and sell the used commercial vehicle through the online mode. Even the KYC, the entire process as far as the, as far as the agreements and everything, So we feel that we are very much there in all the things what is required, as far as the disbursements and the collections are concerned. Only thing is that we are trying to educate to the customer to have a smartphone so that, digitally he can do all the transactions, he can look at his loan statement, he can look at every part of it, So we are trying to educate the customer, even if he pays the money through digitally, we are giving some discounts on the EMI also, as if he pays the money in digital, so that what happens is that our employee does not get involved as far as the collection process, and these people can be used in the more productive ways, But when it comes to the used vehicle transactions, people prefer, to go to the place, look at the vehicle, look at the tire, look at the body, and drive the asset, and that's how they, they have been buying and selling a used commercial vehicle and etc. So once, which is not our cup of tea, but once he decided to buy the asset, thereafter all the process is digitally for us.
Got it. There's a question on the liability side do you plan to increase your foreign borrowing proportion further as over the past 2 years the cost has come down?
See, then you have to look at how the hedging cost, the rupee volatility will be the biggest factor, where we decide. But as we have mentioned that 20 to 25% in all the liability profile, we want to remain irrespective whether those liabilities are 30, 40 basis point higher cost of funds, but we want to remain in all the liability profile.
Okay. Yeah, thanks. I think, sir, there are no further questions at this point of time. So thanks a lot for doing the session and thanks for your insights. Thanks everyone.
Sorry about that. And Subbu, if you have further question for any investor, don't hesitate in talking to me.
Sure. Thank you.
Thank you. Thank you.